Why is it that all of these assets continue to increase in price over the long term at such a rate that is much, much higher than the targeted 2% inflation in the United States? Well, we can look at used cars, for example, here in the United States. So in the US, the used car index is absolutely exploding. Now, all this shows is what is the price of a used car in America? Now, that looks like an insane chart. Probably more insane than the Fed balance sheet chart that we pulled up earlier. Now, the used car index is showing a 50% increase in the value of a used car in recent memory. Now, why is it that this chart is going up so quickly and so steeply? Well, you can't pinpoint one single contributing factor because there's an argument that there is the monetary and fiscal stimulus that is devaluing the dollar, and therefore every asset should go up in dollar terms because the dollar is worth less today than it was in recent years. That is one part of the equation. There's another argument that says that all of the fiscal stimulus put more dollars into people's pockets last year and into this year. So we saw this personal income and the savings rate explode, and therefore people have more cash and they're willing to now go spend it on specific assets, and therefore that can drive the price up. There's another argument that states more people in the United States want cars because they're moving out of big cities into more suburban areas, and where they might not have needed a car because of public transportation or Uber, Lyft, etc. Now they need a car and they're going to buy cars. And so you have an increase in demand, but you have that same kind of constant supply, and that would lead to a price increase. Then you also have what is more of the supply chain argument that states that new car production is actually lagging behind because there is a shortage in semiconductors. And when you have a shortage in semiconductors, that leads to less new cars being produced than is needed. People then need to still buy a car, so they go to the used car market, and that is what pushes the price up. All of those kind of theories or analysis have some kernel of truth in them. So the 50% increase, give or take, of used car prices cannot be attributed just to monetary policy, just to fiscal policy, not to supply chain disruption, not to COVID, etc. It's the totality of these various aspects that leads to that massive increase. Now, will it stay that high? Nobody knows. Will it increase or decelerate in the future? Nobody knows. But what we do know is that today the cost of living is the highest it has ever been in the United States for a person who lives in this country. And so what you start to think about is, what do you do about it? If everything around you is going up in prices and majority of folks are either being paid the exact same in dollar terms and they're not getting inflation adjustments because they are an hourly wage worker, or the inflation adjustments to their salary is somewhere in the 1% to 3% range, but inflation's at 5+%, what do you do? Now, my opinion probably doesn't matter that much, neither do my brothers, because we have data. And if you look at what Lynn Alden, who's one of my favorite financial analysts, and recently put out a piece yesterday that really breaks down what are people doing. Forget what they should do. What are they doing? And what we find is that they are YOLOing into the stock market. That's exactly what they're doing. And so when you look at this chart, what it shows is in the blue line, the percentage of financial assets invested in the stock market for the average US household. And in the red line, it shows the percentage of total assets, including financial assets and others, invested in the stock market for the US average household. Both of them are at all-time highs. The highest percentage of financial assets or total assets invested in the stock market in history. And so if you look at that red line, total assets, what that shows you is that over $1 for every $4 to your net worth is invested in the stock market. That includes your cash savings. That includes every single asset you own. That includes your home. That includes everything to your name. One out of every $4, over one out of every $4 is invested in the US stock market. Why are they doing that? Well, it's because the US stock market has multiple pieces of attraction today. One of it, again, goes to, I have more dollars because the savings rate and the personal income rate is up. And therefore, rather than have it sit in cash, I'm going to go ahead and I'm going to put it into the market. I would have invested in the market anyways. And so now I'm just going to invest more money into the market. And therefore, that leads to this high percentage. The second thing is that I was already invested in the market and the stock prices just went up a lot. And because the S&P is up almost 40% in the last 12 months, that means that my exposure to equities has just grown at an outpaced rate compared to the other assets that I own. And therefore, it has actually increased as a percentage of my total assets. There's an argument that people are literally running from inflation or inflation fears, and they're going into the stock market and using it as an inflation hedge. We've seen everyone from the Jim Cramers all the way to many of the stalwarts across Wall Street talk about this, that equities have now become an inflation hedge. And people don't like to talk about this, but what is likely to also be happening is people have cash and they don't want to miss out on the speculative boom. We see stock prices exploding. AMC, the Tesla stock, we see cryptocurrencies. Everything seems to just be going up. And that is a direct response from the fiscal and monetary stimulus. But people are saying, if everyone else is getting rich, I'm not going to be left behind. And so they literally YOLO into the stock market. And so today, 1 out of every $4 to your name, on average, is allocated to the US equity markets. Is that a good thing? Does that mean that we should be worried? Or should we chalk it up and say more people are interested in investing than ever? This is amazing. We actually want more people to have investments than not. And we've talked a lot, almost at length, about the top 55% of Americans have investable assets. The bottom 45% of Americans hold no investable assets. And so when there is monetary and fiscal stimulus, like we've seen over the last 18 months, that devalues the dollar at a historic rate, those with investments end up profiting and those without end up suffering. Now, that should be a good thing. We should encourage more and more people to invest. But Lynn went on further and did an analysis as to what happens when we get to very high rates of US household income or assets being invested into the US stock market. Well, it's not very good for the next 10 years in terms of returns. So the US equity exposure, the US household equity exposure, meaning how much of your assets is invested in the stock market, is the blue line. And the orange shows what the next 10 years of annualized returns ends up being. And this chart is absolutely fascinating to me because what it shows is that if you go back in history, every time that we got very high rates, at the time, historic levels of exposure to equities in the US, the next 10 years of returns for holding those stocks were the lowest levels. So literally what you can see here is you can see that if you look at, like, let's say 1999 and 2000, literally there was the highest rate up until that point of US households that were holding stocks. No one was going to miss out on the tech boom. Everyone wanted to be in the market. But for the next 10 years, you literally lost money holding onto those stocks on an annualized basis. And so what you have to balance today is that you can have very high rates of return, or you can think that you're going to have very high rates of return. And so you can go into the stock market because you say, hey, for the last 10, 12 years, there's been this boom. There's been this amazing economic kind of a bull market. But what we actually see history tell us is that when you buy in at the price levels or at the equity exposure levels that we're at currently, the returns are less than ideal. Now, as I wrote this morning in the newsletter that I write, the 4 most dangerous words in finance are "this time is different." Now, this time is different is important because maybe it is different this time. We've never seen this amount of monetary and fiscal stimulus. We've never seen this high of equity exposure for the average US household. We've never seen this level of devaluation of the currency. So there are many things where it is different this time in terms of the severity or the magnitude of what is happening. But the big question remains, is this time different in terms of the economic return that you can actually garner by investing in the same traditional assets that everyone else invests in? I don't know. Nobody knows. Joe and John don't know. We don't know. No one can tell the future. But what we do know is that you are guaranteed to lose purchasing power if you hold your money in stock, in cash. So if you continue to hold cash or negative yielding debt, you will lose money. It's a guarantee. And so what becomes fascinating is that we now have entered into a market where there is so much intervention from governments and central banks. There is so much kind of manipulation going on where bear markets have been outlawed and any sort of market correction has been banned, that we now have US households putting 1 out of every $4 of their total assets into the stock market, crossing their fingers, closing their eyes, and hoping 10 years from now, they actually got a great return on their investment. History would suggest that they won't, but that is the current situation that we're at.